Well, greetings to all my investment clients. My name is Walter Mazers, your wealth manager and CPA tax advisor. I'm recording this on Saturday, August 9th. Our weekly stock recap as of August 8th, Friday, meaning yesterday. Just want to go through what the markets did. First of all, I want to apologize for my kind of casual attire. It is summer. I forgot to put a dress shirt on, so again, apologies for my rather casual attire. Just real quick, an update. I think I mentioned I kind of injured my back and shoulder, going through a physical therapy, doing better. It's a slow process, but doing better, walking better, a little less pain. So hopefully, as I continue doing stretching exercises, and I guess a word of warning to anybody at a certain age, my physical therapist is telling me you get to a certain age, stretching your muscles every day is so critical, because if you don't stretch your muscles, they become stiff and prone to injury, kind of when I was moving my daughter back in May. So hopefully everybody, my clients are doing stretching, walking, doing some kind of exercise. But the physical therapist keeps saying, yes, exercise is important, but stretching your muscles to certain exercises to stretch your back, your shoulders, your arms. So anyway, just wanted to give you a quick update. So kind of going in the right direction with my recovery from pulled muscles in the back and shoulder. Before I get into our video talking about the stock market recap as of Friday, August 8th, just disclosure statement. As usual, please read this at your leisure. You can stop the video and read the full disclosure. If you want more information about myself and Trinity Wealth Solutions, you can go to this website, brokercheck.finra.org, and just type in my name, Walter Mazers, or Trinity Wealth Solutions, and there should be a disclosure from the SEC, my background, how many years I've been doing this. Again, just a reminder, this is not investment advice or a solicitation to buy or sell any securities. Anyone else watching this video other than my clients, please keep that in mind. This is not intended for you to make changes to your portfolio. Please speak to your own investment advisor. Alrighty, so now that we got that out of the way, let's talk about the markets. And again, the stock market, if we look as of Friday, yesterday, the market was up. Technology almost 1%. S&P 500 77 basis points, so not quite 1%. Gold kind of flat, and long duration bonds in negative territory because interest rates are just trying to find a direction which way they're going to go. Just a quick reminder to my clients, we are completely out of the market right now. We got a signal last week that there could be a change in trend, meaning the markets could roll over. And it's not only our research company that's saying that. Many technical analysts are saying there's something showing in their charts that's showing high risk or great probability of some kind of pullback in the market. Now, if that doesn't come to fruition, then we will get back into the stock market. Remember, previously we were in QQQ, S&P, SPY, S&P 500, and we got out of those positions systematically as we hit profit targets. So what our strategy does is, hey, if we get back into the market, we set a profit target and we sell off a portion of that investment. And then if we hit the next target, then we're going to sell the rest. Or unless there's our research company tells us, hey, there's a high probability of some kind of pullback. That's why kind of we're out of the market. We're just, as the owner of the research company, Christopher Mullen, says, hey, you know what? We're just staying on the shore, watching the storm out at sea. And before we go out there, venture out with our boat or investments, let's see which direction the market is going to go. So let's get into kind of the 1 day, which I mentioned. Markets had a positive day on Friday. If we look at 5 days, the market QQQ up 1.8%, and technology has been actually outperforming almost everything else. Gold kind of flat. If we look at 1 month, again, QQQ has been really outperforming. Gold has done well too, and the S&P 500 has been not about half of what technology. What's moving technology is really the Magnificent Seven: Apple, Nvidia, Microsoft. They're really pushing the market higher. So it's not a broad-based upside. It's really narrow, which is not a good sign. So if we look at year to date, QQQ is up about 12%, and S&P 500 is about 8.8. Bonds again are flat. Gold did extremely well, up 29%. If we look at 1 year, again, remember we had that pullback in April, almost 20%, and then we're coming back quite aggressively, quite fast, which looks great. But again, the higher the market goes, the greater the risk, the probability of some kind of reset pullback. What is our research company telling us right now? Again, we're out of the market, but potentially 2 trades that we may, our research company calls them discretionary trades, and one of them is definitely gold. If we see, pretty much since April, gold's just been trending up, down in a pattern of really no direction. But technical analysis from our research company and others are saying there's a potential for gold to have another momentum upward, just like we saw from February. Had a very good push up, then a pullback, and then a push up at the end of April. Remember what was happening in April? Tons of uncertainty. And when there's uncertainty, people flock to hedging for safety, and gold is probably the best hedge when things are uncertain in the stock market. And so we're out of the market, so potentially we may be getting into GLD, which is an ETF. What percent? We're waiting for from our research company to tell what portion, and then I'm going to be based on clients' risk tolerance. We could start dollar cost averaging into gold, maybe beginning with like 10%, and then maybe get up to 20 or 30% into a gold holding. And that's going to be a short-term hold, meaning could be only for a month or two. And if we hit, again, the potential for gold is up anywhere from 5, 6, 10, even 20%. And gold moves slow. There isn't a huge volatility, so it's not a risky asset where in 1 day it could drop 10%. At most, maybe 1, which is within the tolerance. So it's not a risky investment. It's relatively safe. There's always risk in every asset class, but gold tends to not move as aggressively up and down, especially to the downside. So right here, if we look at 5 years, we can see the pattern of gold. 2022, there was kind of trading, and then it took off, and there were some pullbacks, but nothing major. And right now here, this is trying to consolidate and see which direction it wants to go. And again, technical analysis is saying this is a setup for a potential probability of upside, even as high as 20%. We really don't know. So stay tuned. That may happen next week. There's some other potential discretionary trades that we may be getting signals, but I will analyze those other discretionary trades, how much risk is in that trade. Most likely, we're going to probably stick to majority of our clients, just get exposure to gold at some point. So since we're looking at the 5-year chart, we can see markets, 2022 was that pullback, and then it took off, and April pullback, and now it's taking off. So again, we're kind of due for a reset. There's lots of uncertainty in the market, and if we look at the economic news for really the last 2 weeks, inflation and interest rates are kind of holding steady. Interest rates are just trying to find a direction. But again, probability that interest rates are going to go down is getting higher and higher. And that's going to present an opportunity to go into long duration bonds. GDP growth was 3%. So that was a very good number. But a week ago on last Friday, the labor market was that was a bad report. Jobs reported only 73,000, where market was expecting 120. But the bigger one is really the revisions for June and July were absolutely insane. I think June, July, the initial jobs report were like 250,000. That got revised to 15,000 for each month. That's a tremendous revision. There's many people in Wall Street saying, well, we can't trust the numbers. What's going on? Why such huge revisions? Is it manipulating? Is it just incompetence, or they have bad models? But these revisions have been going on for years now. So something is wrong in the labor market. BLS, which is the institution that puts these numbers out, the models need to be probably revised. What's interesting also, they're saying unemployment is right now about 4.2%, but that's a misleading number, because what's interesting is the labor market. If after 12 months you've given up on trying to find a job, they just throw you out of that. They don't count you anymore as unemployed, which is kind of silly. And there's reports that count people who have pretty much given up on getting a job because they can't find one. Unemployment is more like 5.7%. So the Federal Reserve did not lower interest rates. Had they known, remember that was on Wednesday, and then Friday these bad numbers came out. Labor numbers, economic numbers. Had they known those numbers, they most likely would have lowered interest rates. And there was two governors, two dissents. In other words, they disagreed. Remember, there's, I think, 6, 7, or 8 governors that vote on which direction interest rates are going to go. Two of them, there was 2 members dissenting to favor a cut. That's only happened once before historically. So there's confusion in the Federal Reserve which direction. They're too focused on concern about tariffs that may cause inflation. Tariffs will not, long-term, true inflation will not cause inflation. Inflation is always caused by too much money chasing too few goods. We're not in that position. The supply of money, it's contracting, meaning what creates money? Remember, debt. People getting loans, or credit cards, whatever. That's drying up. So the supply of money is going down. So that's not going to cause inflation just temporarily. Yes, could prices go up because of tariffs, but that's not true inflation. That'd be transitory, I guess as the word was used in one inflation during COVID. So economically, things are slowing down, lots of uncertainty, and anything could trigger a sell-off in the market. And I guess bottom line, that's why we're sitting on the sidelines. We're sitting on the shore, waiting for the storm to clear up and see which direction the market is going to go. If trend starts to reverse, in other words, that hey, momentum starts to pick up and stock market starts to go up and up, then we can get back into the market. But at this point, we're very, very, very cautious. So hopefully this video helped. If you have questions, concerns, if you have any friends or relatives that would like to sit down with me to do an analysis of their portfolio, how much risk they have, and to get an understanding of how we manage clients' monies. Remember, our number one mantra of added value is we want to protect your portfolio. Our longer term target is to get a consistent rate of return of 10%. Many of our clients were getting close to that, and I think if we do get into gold and some other discretionary trades, we may hit that target of longer term 10% rate of return. So thank you for watching. Hope you have a great weekend. Stay cool. It is hot. And we will talk to you next week. Take care. Bye now.